This company secretly rules the world.
Clearly, they do not need a name in the mainstream media to be successful.
What some call the most influential financial institution in the world's largest shadow bank, and perhaps the company that owns the world.
And in just over 30 years, the company that effectively owns the world.
And I don't mean it in a like, oh, they're gonna own everything kind of way. I mean like, no. They're going to own everything.
The scary fact is that this company does exist, and you have most likely never heard its name before.
BlackRock essentially owns 90% of the world's media. If you don't know about them, it's because they don't want you to.
You've probably come across these videos recently about the most powerful company you never heard before that owns the whole world, the infamous BlackRock Incorporated. When you Google any major corporation and look into their shareholder structure, you'll find BlackRock in the top 3. Tech companies, major banks, retailers, pharma, media, across every sector in every company, BlackRock has a piece of the pie.
Do these things happen organically? I don't think so.
But is that even possible? What about the antitrust laws that are supposed to protect consumers from unfair competition? And when you look up the most valuable companies in the world, they don't even show up in the top 20. Could they be using their immense power to influence politicians, countries, and corporations to stay under the radar and apply their secret agenda? Their Apple, Microsoft, and Amazon holdings alone are worth $218 billion. So how much is BlackRock worth? 96 billion? How can a company that owns the whole world be only worth 96 billion? In contrast, Berkshire Hathaway is worth 630 billion. And the company's founder and CEO Warren Buffett is worth $99 billion. But Larry Fink, the founder and CEO of the allegedly most powerful company in the world, is only worth $1 billion. So why is BlackRock worth significantly less than what they allegedly own? For a simple reason, because they don't own those shares. Berkshire Hathaway is a multinational conglomerate holding group that invests in companies with its own assets, whereas BlackRock is an investment management company that provides passive fund solutions such as ETFs and index funds to institutional and retail investors. When you invest in any of their funds, instead of your name showing up on the ownership list, BlackRock's does. So if they don't own those shares, what do they own then? They have the control over the proxy votes of the shares you invest through their funds. In other words, the voting rights, which are essentially the major voting decisions held by the company's shareholders about the company's future, such as mergers, investment decisions, management compensations, and even executive successions. Putting aside the conspiracy theories, let's actually dive into BlackRock's influence on these companies and its potential impact. By the end of this video, you will understand why this topic is so important, but not the way it's been told so far. First and foremost, we need to understand the basic dynamics of exchange-traded funds, which are the centerpiece of this debate. Let's take the popular example of BlackRock's largest ETF, the iShares Core S&P 500, which essentially tracks the largest 500 companies in the US. The ETF is currently trading around $397. When you give a purchase order to buy the ETF through your trading app, BlackRock or an authorized participant would take your $397 and divide it into the portions according to the weights of each stock in the index, which in this case is market cap weighted. In other words, the more valuable the company, the more weight it will have in the index. So 7% of your $397 would be invested in Apple, 6% in Microsoft, 2% in Amazon, 1% in JP Morgan, and so on. Companies in tech, healthcare, and consumer discretionary will make up more than 50% of your investments. The allocation of capital with these passive funds is not at BlackRock's discretion. Just because they like Amazon more or have better relationships with JP Morgan would not allow them to allocate more funds into these companies. And that's why they're called passive investment funds rather than active. In simple terms, after BlackRock buys these 500 shares on your behalf, they'll put it in a box, call it an ETF, and hand it over to you. Of course, all this happens in the blink of an eye. The biggest innovation ETFs have brought to the capital markets are the ability to instantaneously buy and sell them just like you would do with any normal stock. But instead, you're buying hundreds and in some cases thousands of shares instead of one. And imagine if you were to buy all those 500 companies individually. How much time and effort that would take, let alone the minimum amount of capital you would need to buy all those shares. And once you decide to sell your ETF, the same thing happens, but in reverse. Once you give a sell order, they'll take your box of 500 companies, sell them individually in the market on your behalf, and lastly, accumulate all the money received and hand it back over to you. BlackRock will charge you a management fee for the period you held their ETFs, as well as make an arbitrage profit on the above explained creation and redemption process. Since we got the basics of how ETFs function, let's look at how we actually got here. It all started in the 1970s, when the first index fund was launched by Jack Bogle, the founder of Vanguard Group.
They were bearish when they should have been bullish, and bullish when they should have been bearish. So the index at least steers a steady course.
Before index funds, if you wanted to get into the stock market, you had two options. Either you could pick stocks yourself using a broker, or you could buy into a mutual fund, a collection of investments selected by a fund manager, promising solid returns in exchange for an annual fee. In 1976, Bogle, the head of a mutual fund company, turned the industry upside down. He argued that mutual fund fees were stupidly high, and the vast majority of them generally failed to beat the market. He set up a company called Vanguard, offering a new kind of mutual funds, one that would buy and hold every stock or bond on a major index, and that would devote itself to driving fees as low as possible. And index fund managers did just that, buying shares in thousands of companies without the need for costly analysis, which lowered management fees drastically. In the decades after Bogle launched the first retail index fund, his initial argument has proven to be right over and over again.
Absolutely stunning, because in the last 6 years, the industry has had $200 billion taken out of equity funds, okay? That consists of $600 billion going into index funds and $800 billion going out of actively managed funds. That is a tsunami.
Only 10% of the actively managed US large-cap funds outperformed the market in the last 15 years. With ultra-low fees and stellar long-term performance, these investment vehicles have soaked up more and more money. At first, Wall Street was skeptical that investors would accept making what the market made rather than betting on beating the market. But thanks to people like Warren Buffett, despite taking the opposite approach to his investment portfolio by carefully handpicking each stock after rigorous analysis, he has been very upfront with the difficulties in beating the market and has been a strong advocate of passive index investing. According to Morningstar, investors saved $6 billion in fees by switching to passive management in 2019 alone. This is a net positive for society. You're getting the same exposure to the market for a tenth of the cost. It's a no-brainer, said Jonathan Brogard, a finance professor at Utah University. As of last year, the inevitable outcome has happened, and passive investment funds have overtaken active ones for the first time, reaching $20.9 trillion, of which BlackRock and Vanguard Group collectively managed 60%, showing a clear dominance. Their success had a weird and unintended consequence. As millions of investors have done the most sensible thing financially, they have also concentrated enormous shareholder power into these fund providers. Currently, the three biggest players, Vanguard, BlackRock, and State Street, collectively control on average 18.7% of the companies in the S&P 500. Their ownership of smaller companies is even more concentrated, with 22.8% among mid-cap and 28.2% among small-cap indices. The fund companies say that there is nothing to worry about, because they do not vote as a bloc. And yet voting power is still voting power. The fund companies' combined votes could swing the outcome of important matters, such as mergers, major investment decisions, CEO successions, and so on. Even though no fund house has the ability to decide on the outcomes alone, they are potentially the most powerful force over corporate America today, with their influence growing year over year, which started to ring some alarm bells with some regulators. Environmental and consumer groups have accused index managers for shrinking their broader social responsibilities and accused them of continued investments into oil and gas companies. ExxonMobil is the 11th largest company in the US, which represents 1% of the S&P 500. Unless it gets excluded from the S&P, the argument of BlackRock to divest out of oil and gas companies is technically not possible. As mentioned earlier, the fund is modeled to track the S&P 500 with whatever it holds. BlackRock does not make the investment decisions. It's the investors that decide on which funds they want to invest in, as well as the decision to exit their positions whenever they want to. But the concerns over the concentration of voting power is not without a reason, especially when you see a handful of players with ever-growing share and influence with the potential to affect the trajectory of the largest public companies in the world. As Uncle Ben always told Peter Parker,
"Remember, with great power comes great responsibility."
These companies are becoming more and more powerful, and they should certainly be held accountable for what they do and what they don't. Which brings us to the bigger problem. When you think about it, index fund managers do not have the incentive to invest the time and effort into actively supervising these companies. That's because any effort to increase the value of a company would also increase the value of the index, which in turn benefits every fund that tracks that index. As a result, the fund that pushes the management can't stand out from its peers and attract more money. Therefore, it can be argued that they are more incentivized to be as lean and hands-off as possible in order to reduce their fees. But this also comes with its consequences, such as insufficient checks on corporate managers, and perhaps the argument for inadequate actions for environmental and climate concerns. Last month, senators and legal experts held a meeting over the merits of a Republican bill that aims to reduce the voting power of the three large index giants. Republican Senator Dan Sullivan introduced the Investor Democracy is Expected Act. The Index Act would require advisors to vote in accordance with the instructions of the individual investors and not at the discretion of the advisors. The legislation would require investment advisors for passively managed funds with more than 1% of a public company's voting shares to cast their ballots in accordance with the instructions of fund investors, rather than vote on company issues as the advisor wishes. It's an idea that certainly sounds democratic, but doesn't consider the cost, complexity, or the sheer number of votes that would be involved. For popular, widely held index funds, that could mean reaching out to hundreds of thousands of clients and about tens of thousands of corporate votes each year. Unfortunately, even though the bill is with good intentions, it has the potential to do more harm than good. It would certainly increase the cost of index funds and ETFs, making them less attractive and ultimately hurt investors. Additionally, the whole purpose of passive investment vehicles is for people to have a more passive approach to investing. If the voting decisions are given to each and every investor, either they'll simply not vote, which won't serve its purpose, and even if they did, how educated and well-informed that vote will be given remains an important question. The topic is certainly complex, and it would probably require a complex solution. But it's definitely something not to be ignored, nor something that should be demonized. What do you think? Is the concentration of votes a problem that should be addressed? And if so, what's the best way to tackle it, without hurting the existing benefits it has created for investors? If you made it this far, welcome to Financial Interest. We make videos on interesting financial topics. If you had a good time and learned something new, I would highly recommend you to check out our previous videos. To support the channel, don't forget to like and subscribe and share it with your friends, and I'll see you all next week.